We'll get going. Well, welcome everybody to the property investing session, high rental income and capital growth at the same time. We found that there's a lot of confusion about this subject, so David and I came together to put this together. Feel free to leave the cameras on if you want to. All we're asking you to do is to please mute your microphone. And actually on that, a bit of housekeeping. We are at a virtual session, so it can be challenging if technology is not performing. Let's hope that everything will go okay tonight. If you want to put on your camera, that's great. Don't be shy. We are all good. There's nobody going to get shot here. Just keep your microphone on mute, please. We will have a Q&A session later on, so everybody will get the chance to ask questions. Yeah, and thank you for joining us. That's the biggest thing. All right. Unfortunately, I have to give you a disclaimer. Please, everybody, do your own research. I realize you can't read that. Please, everybody, do your own research. Investment is a very personal thing, so please talk to your own advisors. That's the short end of it. As to today's agenda, we wanted to keep it very simple. The agenda is: how are we going to do this? What is there to be done? With whom? Who are the parties that you need? What's next? And the big thing is the why. So the issue is really, why do we need high rental yield and why do we need growth? So high rental yield, I call it the short-term money, meaning the cash flow is hugely important from the rental income, because the rental income pays the mortgage and the cost. So if the rental income is too low, what that means is that we have to take money out of our pockets. Now that's not good for lifestyle. It's also not good for financing, because you very quickly hit the wall if you don't have enough funds coming in. I call it the small money, because even if you have positive cash flow, which is maximum in typical cases $200, $300, $400 a month. So let's go high, let's call it $400 a month. That at 12 months is, call it $5,000. Now remember that figure. We'll get back to that. But the real issue about high rental yield is the rental yield should cover all cost of the property, as far as we're concerned. Now, what does that mean? It means that we need to calculate the financing at 100% financed. Oldest trick in the book of the marketeers? No, you don't have to calculate finance for the $100,000 that you're putting in yourself. That's your equity. You've got that money sitting on the side. Bullocks. That 100,000 needs to be attracting interest as well, because even if you have it sitting in cash on the bank account, you would get some money for that. So the rates need to be covered, the interest needs to be covered, the rental manager needs to be covered, everything should be covered by the short-term money, by the rental income. Because if it doesn't, you're going to take out of your after-tax income and have to subsidize the property. Now, subsidize the property in the hope that there will be capital gains in the future. Now, famous example, Sydney. 7 years, no capital growth. On top of that, it is a market where traditionally the rental yields are very low. So people were paying $500, $1,000, $1,500 a month of their after-tax monies into the property. Now, I don't know about you, but in my case, I may be able to do that for one property, but certainly not for 2, 3, 4, 5. And it curtails your lifestyle. This is when our subconscious turns us off, certainly after a number of years, when you can no longer go out for dinner, can no longer go for holiday because you have to fund the negative gear. So our suggestion, our recommendation is find markets where you have sufficient rental income to cover all costs. Now, capital gains, that's the long-term money. It makes sense. The rental yield comes in monthly or even fortnightly, depending how you've set your finances up and what arrangements you have with your rental manager. The long-term money, the capital gains, is only realized upon sale, which in my books has to be 5 or 10 or more years later. Now, why is the capital gains so important? Well, again, we talk about lifestyle. The capital gains is the big money. This is where you have, let's go very conservative, 5% on a $500,000 home per year. 5% on a $500,000 home is $25,000 for the first year. It compounds thereafter. But that's what ultimately is going to get you the lifestyle. Because when you can capitalize out of that later on, that is what is going to pay the mortgage and give you the capital growth. So that's where the real money sits. Let's not forget that. For the refinancing, we need the capital growth. If you want to jump from one, oops, that was a bit fast. If you want to jump from one deal into the other and withdraw equity, we can only do that from capital gains. So that's when the property has risen, as in the example on the screen, 18 to 24 months it was, $180,000 capital gains. Now, of course, you can redraw that. 80% of that can be redrawn. So the investor could withdraw $140,000 and use it as equity for the next deal. And that is how you build a portfolio. You don't do it on the rental yield because the rental yield is too small, even if it is a positive gear. So the capital gains is where the big money is, no question. But we need both. And we need both to go forward. We need the rental yield to survive day by day and to be able to go the distance for the capital growth. That's the easiest way that I can explain it. And if your property doesn't provide you with enough rental yield, it will also be difficult to get bank finance for further properties. So how to do this? Well, as far as I'm concerned, it has to be all about you. As far as I'm concerned, we need to start off with where are you at and what do you want to achieve? Now, this is where 95% of the industry goes wrong. They sit you down, they have a discussion with you for 5 minutes, and then they look at their stock list that is as long as their arm, and they pick the property that they need to sell fastest or that somewhat matches with your strategy. Well, as far as I'm concerned, we ought to start off where are we at and what do we want to achieve? And then and only then can we devise a customized strategy for that one person. And that takes more than half an hour discussion. It takes an in-depth understanding of what's your risk profile, what's your family situation, how much disposable income have you got. So to really knuckle down and get the full understanding takes some time, and that is well invested time. That's for sure. It's all about what's the end goal. That's what it is all about. And that is different for everybody. Hence, an investment strategy ought to be personalized and ought to be different for everybody. Hence, the idea is to develop a customized strategy. Very, very simple. Okay, so what is there to be done? Okay, so we want to look for balance between yield and growth. I suggest a minimum window of opportunity of 5 years. Consider the risk versus reward. My usual example when I talk to people is, how do you cross a 4-lane highway? Do you go and run blindfolded across all 4 lanes? Do you look left and right, and when there seems to be no risk, no cars coming, you walk across? Or do you only cross that 4-lane highway when there is no car to be seen for miles? Again, everybody is different. So what's your risk profile? What can you stand in regards to income, in regards to assets? What is your timeline? So that then all leads to what's the right deal for you. We do that in a discovery session, and here's an offer for you. You can log on to the website. There are a couple of spots where you can register for a 30-minute free discovery session where we just have a general chat to see what's cooking and what is working for you. What do you want to achieve? Where are you at? That has to be the beginning of the discussion. So let's hear a bit from David. David is the Managing Director of First National Accounts. Up top in picture, at the bottom on my screen in real life. Welcome, David. Thank you.
Thanks, Uwe. Thanks for inviting me.
I wanted somebody in the field rather than me talking. David is the MD of the Cairns office and has been a member of the board of First National. So you can rely on him giving it as it is happening. And one of the markets that we quite like is Cairns. So I wanted David to give us a bit of feedback. Over to you, David.
Thanks, Uwe. And tonight what I'd probably like to do is paint a picture of a market that's actually quite resilient. And I'll start doing that by going back to about March last year, early last year anyway. And at that point, we were staring down the barrel of some pretty nasty sort of thoughts with regard to what COVID-19 was going to do to our city. Prevailing thoughts were that the tourism and hospitality in a tourist town would be hard hit, and as such, we would find that many jobs would be lost, and the ability to pay rent across a number of people would therefore create huge vacancy rates. Through 2020, the first part of that equation was absolutely true. The hospitality and tourism industries were hit very, very hard. But the resultant effect on the rental market for us was not quite the same. In our own portfolio, only 3% of our properties were subject to special arrangements for the payment of rent, and our vacancy rate was constantly under 1% and regularly under 0.5%. That's not to say that there was no effect across the rental market. The short-term rental market really did suffer huge vacancies, and many in that sort of space tried to move their properties into long-term rentals, but not all of them were actually suitable for long-term rentals. Furnished apartments were also particularly hit hard, and obviously there was some crossover in that sort of short-term and furnished market. The shining light in all of this was houses, and houses through 2020 continued to attract good interest from tenants. It was thought that the real estate market in Cairns would be hit badly by the pandemic, but in actual case, I'd have to say that that was not the case in the real estate residential side of things. It was certainly very different for commercial, but that is a story for probably another time. Rental stability and demand in Cairns is good. Long-term rental experience shows that the long-term rental market in Cairns is one of steady growth. We've seen houses continue to demand good rents, and units have been patchy in terms of the marketplace, but dependent very much on their location, their size and quality. Vacancy rate across Cairns for the last probably 12 to 18 months has averaged out at about 1.2%. Our own vacancy rate has been under has not exceeded 1% for I can't remember how long, and many of the times it's been at a 0.5% levy, or rate I should say. The question that I'm probably certain that you're all thinking is, why is this the case? And I think it's because of a couple of factors that create the competition to get property in Cairns. The first one is population growth. Population growth in Cairns over the last 10 years has averaged at about 1.9%. And that's according to the data from the Cairns Regional Council. And that extrapolates on today's population an increase of about 3,100 people per annum. Now, if you then now look at building approval trends, they're sitting at about 300 to 350 a year. At the same time, we're looking at rent rolls, rental pools, whatever you want to call it, diminishing in size. So clearly what we have is nothing short of a housing shortage, and I can't see this changing for any length of time. I see this as being a problem or an opportunity for quite some time. In terms of capital growth, from probably 2015 to late last year, we saw a pretty steady market. It wasn't belted by anything, but it didn't go up a lot. But the March REIQ, Real Estate Institute of Queensland report for the December quarter shows that the median price for houses for the quarter was $435,000, which is up over the annual median price of $420,000. So we're starting to see some growth. It's my belief that this was the beginning of a strong price increases, and that I'm very anxious to see the June report, which will reflect the March quarter, where I think that will show further median house price increases and strong volume increases. Not the same story necessarily for units. The median quarter price is $220,000, which is down from $225,000 5 years ago. And as again I said, you've got to be very careful when you're measuring across so many different sort of suburbs to make sure that you're looking at what I said before, dependent on location, size and quality. We've experienced in the last sort of 6 to 8 months or 6 to 9 months, strong inquiry for both houses and units. And I think that probably the one message I could give you is that we've actually got a shortage of stock, and we're seeing that in some of the sort of behaviours in the marketplace where we're selling houses, especially first weekend. We're getting for buyers and taking it above asking price. We're not talking about the sort of fever that's happening down south, but we are talking about a strong market. I'd sort of draw your attention to a watch this space type scenario, and I'd keep an eye on our builders and tradespeople. We're seeing an increase in the difficulty of getting trades, and the street talk, and sort of, it's more than anecdotal. Builders in many cases are just overbooked. Combine that with material shortages and price increases for home construction, saying I think it'd be well worth watching. Other watch spaces is the pressure from southern buyers. We're seeing southern buyers move into our market. I again caution any reading that you're doing on the in the media. This is not red hot fever pitch, but what we are doing is we are seeing it happening, and we're seeing it happening more than it was before. So all in all, I would paint the picture of a resilient market, a market that survived well through the early days of the pandemic. We're obviously still going there, and a market with a excuse me, an under pressure to keep rental returns on the increase. Happy to take questions whenever, Uwe, but that's my thoughts at the moment, and hope that helps.
Yeah, thank you, David. I think it's very pertinent and very interesting. Cairns was one of the few markets that was very much to a minimal effect influenced, certainly on the rental side. You alluded to the fact that we were all worried that we're going to see requests for rent reductions in droves. I think across our team, there were some 8% of inquiries, but only 3% got actual rent reductions, so a very small figure. But I find it very reassuring that the rental side held up, because again, I come back to that's the short-term money. That's the money that we all need to live from day to day. And if I can find a market which provides that, that has to be a good thing. Now, allow me to just come back to the pressure in the market that you alluded to from the builder's point of view. We only do new house and land, and we only do wholesale, so that we can get the better deal for everybody. And even for us, it is challenging to get land, and even more challenging to find a builder that can start anything before 6 months. Now, we have seen price increases. I got a phone call from a builder this morning that tells me on a, let's call it $500,000 home, his costs have gone up 17,500 in the last 6 months. The biggest shortage out there is the roof trusses, the wood, which, as I understand it, is derived from one, the fires that happened last year, and two, the increased demand all over Australia. So there is very, very little doubt in my mind that we'll see about 10% growth. This is just my crystal ball, my private opinion, not financial advice. You gotta give all the overriders. But I'm certainly expecting 10% and more growth in Cairns in the next 12 months, which is simply a factor of the higher demand, the higher prices, both in supply as well as in production. So, yeah, very interesting. All right, I wanted to keep this session snappy. We'll get fast to the questions. A couple of words what are the benefits of a company like First National with David and probably friends ourselves? Well, we've both been in business for a long time, 20 and more years. In the case of Property Friends, 76% of our business is return business. Now, I'm quite proud of that, because what that means is that our strategy works and we can duplicate it into further properties. As far as I'm concerned, most people come to us to either derive an income, get retirement strategy out of the way, or some people want to leave a legacy. You don't do either of those with one house. So the 76% return rate mean that our properties, our deals work. And again, that comes back to rental yield. You need the rental yield to be able to keep going. Yeah, let me just cover off the other things. Our 7-step success system provides accurate, unbiased information, training opportunity, and we mitigate risk. Now, the biggest thing is that we run under full disclosure. So that what that means is you pay what we pay. There isn't a dollar in the deal that you don't know about, and our fee for service is separate to the deal. Again, doesn't it make sense? We all serve the one that pays us. Now, we want to serve you, our clients. Hence, we make it the golden rule that has been standing for 20 years. We get paid by our clients separate to the deal. Because that way, I can look you in the eye and I can say, I pay the same that you pay. Now, naturally, being at the wholesale end of things, we can get our buying prices lower than the market. And we can leverage all sorts of services. We set up strategic alliances for which we don't get any money. Why do we do it? Well, my wife and I are just part of the team. We need the same services. So David and his company are one of the rental managers that we're dealing in town with. And it's been a pleasure to work with this team, which is also why I invited him to come online tonight. And he's a heck of a nice guy too. So there you go. Yeah, so what I would like to do is, with your permission, run a very short video of one of our clients, and let's see whether this works.
My ambition with this my first venture into the property investment was to alleviate the difficulties I had previously with trying to accumulate some wealth. Superannuation had crashed and banks were useless. So I thought, and after talking to Uber and Property Friends and their mission, I thought this has got to be the way for me to go. And to get a decent return on my hard-earned cash over the last 40 years I've earned. So I hope to gain out of this. I hope to get a good capital growth. I hope to be able to use the capital growth to go into more investing and hopefully stop working in the rat race within the next 10 years. The most important outcome of this project has been that I now don't have a fear of investing. I was very fearful of throwing my money into something and I wasn't quite sure, but Property Friends have taken that fear away from me. Once I get this settled and it looks like it's doing whatever I expect it to do, I'll be talking to Uber and all again, and we'll see what we can do again. I've had a couple of friends ask me what I'm doing with my life, and I've of course been pretty proud to tell them that I've got an investment property happening, and they've asked, should they, why would I talk to someone else? Why don't I do it myself? So I've said to them that if they're thinking of investing, all they have to do is give Uber a ring, he will tell them all they need to be told over the phone. If they meet with him, they'll understand what sort of people that they might be dealing with. And that gave me, and I would be sure gives them a warm and fuzzy feeling, and would give them the confidence to let Uber and Ula and Property Friends handle any investment property for them.
All right. I've got to admit, I'm quite proud of that testimonial. Mick has been a long-time friend of ours, and it's an absolute pleasure to look after him. So again, I invite you to book a strategy call. It is a free service that we offer. And let's get into Q&A. We've got a couple of people live on the call. So fire away. Allow me to just go back to the chat. Lenny, do we have any questions? Okay, forgive me, I gotta do this way. Why? I've got bifocals, otherwise I can't read. It's getting a function of getting older, I guess. Okay, so let's have a look. Why do you, question to me, why do I suggest regional centers like Cairns? Well, the answer to that is quite simple. One, most capital cities invariably have very low rental income. In Melbourne, around 2.5% to 3.5%. So that certainly leads to what I call feed the dragon, or the negative gear situation where you take money out of your hip pockets, of your after-tax money. And that just doesn't make any sense in my books. It curtails lifestyle. It is living in hope for the future. And you can't do it in the long run for multiple properties. So that's the short end of the story. You're forking out money of your after-tax income in the hope that you have time to market right. Now, in my books, it's not about timing the market, it's about time in the market, which is also why we are suggesting it's a minimum of 5 year, if not a 10-year game. So how do you see that, David?
Yeah, look, I sort of totally agree. I've been working in regional centres for quite a long time now, and regional centres often overlooked by people, but regional centres have offered me for probably the best part of 30 years, tremendous opportunity. One of those regional centres might be very surprising, and that was Alice Springs.
Mm-hmm. Yeah. All right. Jakey is heading off. Thanks for the insight. That's a pleasure. Let me go back. Okay. David, what are your predictions for selling in the market in around 5 years?
Yeah, thanks for that one, Uber, or whoever rang that.
It's not me.
Okay. 5 years.
Yeah, that's me, David. It's Steve. Yes.
Yeah, good on you, Steve. That's great. Thank you for that.
So I just want you to get your crystal ball out and start polishing.
I think you just gave me a hospital pass. Now, look, honestly, I'm pretty buoyant about Cairns. I really do feel that we've sort of seen the sort of the dull times, and I'm actually seeing a market that's actually representing a supply shortage. And there's pressures that are sort of coming sort of to a head, really. We're starting to, and honestly, it's kind of like the silver lining of COVID. All of a sudden, we're seeing pressure from the south again. And this comes in a cycle from pressure from the south. It was there in the old investment days prior to 2008. It hadn't been there for quite some time, and it's back now. People are seeing this as a stable opportunity and an opportunity for lifestyle as well. And lifestyle sort of, if you read the newspapers at the moment, you know, you see lifestyle sitting right up there. And the thought of buying your own home has now sort of become more important. And your own home is sort of not only just the place to live, but in some instances, it's going to be the place where you work moving forward. The shortage of rental properties here in Cairns, I believe, is heading into, it's going to continue. I reckon the shortage is going to get worse and worse and worse. And I see that as an opportunity for investors at the moment. We're seeing on our rent roll investors selling out at the moment, and a lot of that being purchased by owner-occupiers. But quite frankly, I really see this as opportunity for investors to be sort of counter-cyclical. You know, I'm never one for planting avocados when everyone else is planting avocados. You know, you want to be doing that when they're not. And I think right now is your counter-cyclical opportunity to invest in Cairns.
Mm. Yeah. So in that, I've just been like looking at the sales cycle, I guess, of property prices in Cairns. It does seem like fairly stable, but also fairly flat. Like it hasn't, like in terms of house prices, but that's a good thing because what that tells us is that it's very stable. It's for those, like myself, it's, potentially risk averse, some may say, but like it's a good thing in that sense.
Yeah, look, there is an interesting sort of aspect to this, and that's the sort of the student accommodation. As this town becomes more of a university town, and it is growing in that respect, we'll be reliant on obviously student accommodation. Obviously, that's been belted over the last 12 to 18 months. We haven't seen any kind of impact to the long-term residential tenancy market at all. And I think, what we're seeing is people are recognising it for what it is. And I really do believe that the information that we've got now is only to the end of last year. And we felt that the market changed in November. The market has been strong since January, and I think you'll see that when the June report comes out for the March quarter, you're going to see significant increases loaded on top of what we saw in the last quarter of last calendar year. So I think, Stephen, you'll see that there are actually
Increases in house values, you're saying?
Increase in median house prices especially. And I actually think you'll see an increase in unit prices as well.
Then that's actually, again, the fun part about Cairns. In your case, Stephen, and you alluded to it, yes, the capital gain took longer than we expected, but at no point in time did any one of our guys had any issues with income. The property always paid for itself. And that is a risk mitigating strategy.
Yeah.
So,
yeah, cool. Thank you.
Pleasure. Geez, I love you today, David. Why is the rental pool shrinking?
There's a few factors. As I alluded to just a minute ago, we've got investors sort of unloading property at the moment, and a lot of it being, or most of it being bought by owner-occupiers. And investors have not been in the marketplace until probably early this year, when we've seen a significant increase in numbers of investors turning up, but still not enough to actually make rent rolls increase. On top of that, prior to COVID, we saw a lot of property move out of the long-term rental market into the Airbnb and short-term tenancies. I'm not too sure that they're all happy about that move right now, because they really did cop a belting. It's higher risk, and you know, I think you probably find that moving into that market, you're moving into a market that has oversupply, rather than being in a market, the long-term rental market, that is a market that's undersupply. So it may not be as glamorous and it may not be as exciting, but you know, in my book, those long-term tenancies with a shortage and a consistently increasing rental sort of return is the place to be. So two of the reasons, you know, we've also not seen a lot of, you know, major unit developments, and when you're approving 300 to 350 houses a year with a need for a population growth of 3,100, you know, you're not actually replenishing the investment pool, are you?
Absolutely right. We've got another question here, a curly one to me. Isn't the capital growth higher in the capital cities? Greg, excellent question. The answer is, it depends whose statistics you believe. It's also got to do very much with timing the cycle. If I take again the prime example that I have in Sydney, for 7 years nothing happened. Now it probably did 70% over the next 3 years. And yeah, even if the capital growth in the median is, let's say, 2 or 3% higher in the capital cities, which statistically is not the case. I can furnish you with statistics that say the opposite. The big challenge that I have is you gotta stand the distance. And it simply doesn't make sense, in my view, to having to curtail your lifestyle by taking after-tax money out of your pocket and feeding the property. That's not sustainable. It is not good business sense, because you're getting 32 cents in a dollar. Now, if you want to get 32 cents in the dollar, I'm happy to take hundreds and thousands of dollars from you and give you $32,000 for every $100,000 that you give me. So when I put it that way, everybody goes, why would I do that? Well, that's negative gearing. I suggest that positive gearing is a lot better, but we still have the non-cash deductions that reduce our tax. But from a cash flow point of view, you're not hurting. And that is what regional cities do. So I guess what I'm saying, Greg, it goes back to risk mitigation. If you are prepared to go back to my example, run across the 4-lane highway blindfolded, good luck. If you want to time the market, good luck. I've been in it for 20 years. You've been in it for a long time, Greg. I can't do it. Yes, there are pointers, but ultimately nobody can predict the market. You can take an estimated and educated guess against it, but I'm simply saying that it doesn't make sense, even if it was 1 or 2 percentage points, and that's the maximum that it can be, to run the risk, to run the gauntlet. Does that give you an answer, Greg? He's nodding. Okay, sounds good. David, why are properties selling so quickly now?
Look, I think that question probably relates mainly to houses, although we are seeing the same sort of thing every now and then with units. But I think the main reason is that we have a shortage of supply, and I keep saying that. The stock coming onto the market at the moment is not enough to satisfy the demand for from buyers, and you know, I can probably relate to a couple that I've sold in Redlynch. both of them first weekend. One over the asking price, one at asking price. One recently in Moorabool, house on the market. It actually went as long as 3 weeks. Then we had 4 people fight over it, and it sold for more than what we're asking. Yeah, so I think it's just a simple answer: supply.
Yeah, yeah. Okay. Look, I'd like to leave it there. I promised to make it short and sharp, so I think we've done that. Again, you can book a strategy call. Both David and I are open to take questions. You can feed them through us, through our website, and we'll make sure that they will be answered. I trust you got some good nuggets out of this session. I'd like to thank David for coming and being part of this, and of course, you, the audience, thank you for that. I will send the recording out to you so that you can go back if you want to. All right. Thanks very much. Thanks for being part of it, and have a good night.
Thanks, Herbert.
Bye-bye.